When the market is ugly, it benefits mortgage rates, unfortunately, but it means our overarching economy is in the gutter. And that's exactly what's happening right now with employment.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast. My name is Paul Stevenson. I'm joined as always by David Warren. We are both level 2 mortgage agents, and we're here to bring you the latest, the greatest on Canadian real estate. I want to give a quick shout out to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, and Centum. David, how are you doing? What's going on?
I am doing fantastic. We're afternoon on Tuesday instead of morning. I'm much more awake than I normally would be. Which is nice.
One coffee in, I'm 8 coffees in now, so I'm just wired. Very alert, as Greg would say. Great. Coming off a great weekend. We celebrated one of our best friends' weddings. Congratulations to Marcus and Taylor. Anyone listening? They leave for their honeymoon today, so very happy for them. It was a great festivity, great party.
Crowd's just lucky that in our joint speech that we didn't plug Torup on it at it.
Yeah, we thought it might be a bit tacky, eh?
Yeah.
Hey, it's Paul Stevenson and David Warren from the Ottawa Real Estate Podcast. We're here to give a speech for the.
This is actually a live recording.
Yeah,
fire away.
That's awesome. Yeah, no, all in all, though, great. It was a great weekend. It was great to celebrate, and getting everyone together for an event like that is I'm sure. I mean, the planning I can't even imagine, but just kind of all being together and celebrating is a lot of fun. You kind of take it for granted when you're younger, being able to hang out with everyone all the time, and it was just great to kind of be around everyone and celebrate and have a fun night. So here we are, back in the saddle. Tuesday, lots happening. David, what are you seeing? Job numbers, ugly, market heating up, rates maybe coming down. What's happening?
Job market atrocious, and I'm sure numbers came out after we recorded last week. So the consensus market was expecting a 10,000 job gain, and we ended up with a loss of 66 jobs. So really a swing of 76,000 jobs, which is an enormous drop for Canada, a country of our size. And really, based on Stats Canada, we have lost 106,000 jobs between July and August. So our unemployment rate ticking up to 7.1%, which is the highest level actually since 2017, kind of removing those COVID years, a brief couple of years, which was, really terrible to see. And kind of, I said it on the last episode as well. When the market is ugly, it benefits mortgage rates, unfortunately, but it means our overarching economy is in the gutter. And that's exactly what's happening right now with employment. We're seeing that up. Obviously, with the tariffs are starting to really hit a lot of different markets, especially ones like Windsor, Oshawa, like a lot of the Hamilton, the ones that rely on automotive and on industrial. So I think we're going to continue to see those unemployment rates jump up in there. I think Windsor's at like 11% and Oshawa in the 9, I believe, or 10%. And so it is really hitting those other markets dramatically. What does that mean on the mortgage side? Because of that weaker than expected employment report rather, 2 of the major banks have increased their odds of a September 17th rate cut. So Scotiabank and BMO are projecting a 0.25 point drop on September 17th, which is a kind of a divergent from their original standing. RBC is remaining cautious, but they're kind of expecting Bank of Canada to hold, but we'll see. The futures market and the bond market yields dropped sharply from that. I think down about almost close to 20 basis points from over the last 5 days from that announcement or the job numbers. And the futures market is now factoring in a 90% probability of a September rate cut, which is, pretty damn high. We do have inflation numbers coming out in Canada September 16th, which obviously could, drastically impact that if the core inflation is still really, extremely sticky. However, there's a lot of economists that are saying like, hey, we might need to put this whole conversation of inflation to the wayside, and focus on the overall economy, which obviously with unemployment rates above 7%, that there's a lot that's needed to be injected. We're seeing, like we talked about last episode, we're seeing small businesses, their default rates and bankruptcies tick up. There was BDC, Business Development Canada. They had on their books, I think, 543 million in projected losses, and a further 623 million in loan loss provisions. All BDC funds is small and medium businesses, so obviously that's a sign of kind of things rippling out. I think they got to kind of look past the inflation numbers to really look at the broader economy, which is showing resiliency in some areas, but also like heavily hit in others.
So, Dave, you mentioned inflation numbers are going to be coming out soon. So, assuming that inflation data comes in hotter than expected, like, do you think the Bank of Canada will hold rates despite the labor weakness, or like, how do you see the next couple weeks transpiring?
I think they, kind of just similarly to what I was saying about inflation numbers, like if the core inflation, so long as it hasn't spiked, I think they really need to look to get away from focusing so heavily on inflation right now, just because there is, like I said, so much going on in the market that's evident that, there's massive job losses.
Yeah.
There are, we've got still inflation is, still hovering in the range of what they'd like to see. So it's not kind of out of the ordinary, but we're seeing, massive losses and lack of investment by businesses. Seeing again, unemployment rates in those areas hardest hit by the tariffs. Those tariff issues are starting to roll through. But we also then have, like we've talked about in the past, where we are so heavily reliant on the US as well.
Mhm.
Obviously, that's why, the tariff issues are kind of driving some of these areas and unemployment rates. And so we got to kind of see what the US is going to do. And the US isn't doing that well either. However, there is a large and strong probability of them dropping their rates. As their inflationary data comes out on Thursday at 8:30. In the U.S., the market consensus is that they're expecting a little bit of a tick up, but they're at 2.7 in July. They're expecting it to be 2.9%. But their job numbers have been really bad. In the US, they've got a dual mandate, maximize employment, but also price stability. And they're having issues on both sides of that mandate. But right now, they're like for the American, like the employment data from trending economics for the US is the number of American job openings are currently less than the number of unemployed persons. So this is the
Right.
first time it's happened in over 4 years. So there's unemployed people in the US, 7.384 million. US job openings, 7.18 million.
Yeah.
That's
What's crazy about that, from what I'm seeing, the S&P index. We talked about this a few weeks ago, but the S&P is at basically all time highs, which would typically indicate that the U.S. economy is flourishing, right? But we talked about kind of that Mag 7, like the top 7 to 10 companies within that top 500 are really driving the market and bringing it to those new highs. And a lot of those companies are focused on, chip development, AI technology, like, the Facebooks, the Metas, like Meta being them, Nvidia's, all those companies, Apple, those companies are kind of driving the market, which, with all the automation that's coming in, is probably not helping all these unemployed people. So it's a very weird dynamic happening down there right now where the market is at an all-time high, but the unemployment is, like you said, 7.3 million people. And for the first time ever, less jobs available than there are people that are unemployed. So I don't know what's going to happen. And I don't know what that means. I mean, the whole global economy basically feeds off of the US economy. Like you said last week, either the US is buying and importing from other countries, or, we're buying stuff directly from the US. So if their numbers are being impacted, it's going to ripple out to our economy, our housing market, essentially, and ultimately, it's going to drive our, rate cuts and everything as well. Do you think, like, I've seen the bonds in the last week? We talked about this the other day. Bonds are down, I think, just over a quarter percent. I think when I looked last, they're at 2.76% for the 5-year Government of Canada bond, which directly impacts the fixed rates. I've been telling everyone, at least over the last week, like there's a strong likelihood we might see fixed rates decrease over the coming weeks, which seems inevitable at this point. Like, where do you see the fixed rates going in the coming month or two? A lot of renewals coming up again at the end of the year here.
Coming down. I mean, they kind of peaked. They bumped up last month, beginning of August, when the bond market jumped above 3%. But in the last month, they've come down 30 basis points. Banks have not pivoted. For the most part, they haven't publicly pivoted. There are some institutions that have like some rate discretion that are very, very strong, but by and large, they haven't dropped rates just yet. I think right now they're, really when they're doing that, they're padding their margins. But I do think that predominantly fixed rates will continue to come down. I think, especially, and we talked about this months ago as well, kind of that expectation of a quarter point to a half point drop by the Bank of Canada before the end of the year, putting us, around, kind of in that bank, that would put the bank prime at 4.45 as prime, versus where we're at now of 4.95. And I still think that holds true. And with that is going to be fixed rates being driven down, because, yes, Bank of Canada rate decision does not directly impact fixed, but there is that, there's a close correlation that, they're having to drop, like Bank of Canada's having to drop the overnight lending rate due to the economy. And that, obviously the bad news in the economy drives bonds down as well, those yields down. So I think it's going to continue that downward trend for those coming up for renewal. The fortunate thing is that there's more and more options out there for lenders. There's, it's you're able to take advantage of not just signing what's offered to you, look at what you might need to do of debt consolidation, pushing out your amortization potentially to make sure that what you're paying in your mortgage is fitting within your budget. But yeah, I think it's going to continue coming down for the next few months.
Yeah, and I mean, something to consider as well is that I saw a stat that over basically roughly in the next 18 months, half of all outstanding mortgages are set to renew by the end of 2026. So I think it's a good thing that rates are starting to ease. As you said, it's kind of a negative for the overall economy, but for basically half of people that own homes that have mortgages set to renew, this is kind of that bit of easing is going to help them as far as their bottom line goes. A lot of people kind of locked in during the pandemic at those ultra low levels of, 1.9, 2.5%. And now they're coming up for renewal and they're looking at, 4.5 type rates. So I have noticed myself, especially the last, I would say 2 months, clients are extremely rate sensitive. And no criticism to the clients, more so just like they're every 0.01% matters. And they're really looking at like, what is that cash flow monthly? How much extra money do we actually have to live? And so on. And I think that this kind of renewal wave over the next 18 months is really going to have an impact on kind of the broader economy and how people are spending their money. And people are kind of using this as an opportunity to revamp their overall financial picture. Whether that means restructuring the mortgage to ease some of that monthly burden, or it means, okay, we're increasing our mortgage, we have to cut out XYZ from the budget, So like, how do you see, or, how do you think, in your opinion, just that was my feeling, but how do you think this renewal wave is going to impact kind of the broader economy in Canada?
I've been seeing people come up for renewal recently, and in those conversations, they are rate sensitive, but they're also more attuned to where rates are. I find, a year and a half ago, there was such a shock when talking about rates, and or even I guess maybe 2 years ago. It's hard to dates blend in now, but we were 5-year insured mortgages in the 6% range. Right now we're in the low fours and high threes for fixed rate mortgages insured. And I think people forget that was what was there even that short period of time ago. So when that happened and rates really spiked up with that continuous increase of bank prime and the bonds kind of jacking up, people were really, it was like a shock and awe. Like they were like, what the heck are you talking about? Rates have come down basically 2% from where
Mhm.
they were 2 years ago on fixed rates for insured. And people are more informed, and it's kind of more like they're just, I don't know, like in those conversations with people coming up for renewal, they've been looking at it and following the rates for quite a while. And so it's not a big surprise. And in my conversation, a lot of them kind of make that joke of like, I know I'm never getting that again. But they kind of just say like, okay, well, let's now like hone in on what we can control. And that is like, what's my monthly budget?
Mhm.
What can I afford? What's my goal for a period of time to pay off or that payment or debt consolidation, whatever it may be, like I said, and just honing in on that. Rate, can't really control rate. We look at what all the best options are and compare, but what we kind of hone in on is that budgetary aspect.
Yeah, great example of that. Actually, I had a set of clients that bought last August, and when they originally got approved, which was in probably June of last year, the rate was 5.34. Then I was able to get it reduced to 5.14 before closing. And then on closing, it was as low as 4.99. So like we basically had two float downs between the time they got approved and the time that they closed. They're coming back to me a year later. They took a 3-year term. They came back to me a year later, say, hey, family's growing. We need to do some renovations. So now they want to restructure the mortgage. They want to add 35,000 to the mortgage itself. And the rate now for the refinance is actually lower than the rate that when they bought, which, typically refinance rates are a bit higher from lenders. Now, they purchased at 4.99. They're paying basically a 3-month interest penalty. We did the calculation yesterday, which was about $3,000. And now they're restructuring at a rate that's in the mid fours. So they're literally going to save like whatever they're paying in their penalty. They're getting 30,000 out of the home. They're getting a lower interest rate, and just from the interest and payment savings, they're pretty much going to offset that penalty in the next 2 years, which is what they had left in the term. So, yeah, it's a very interesting time, and for anyone who did buy in the last 2 years, I would encourage you to reach out to Dave and I, especially if you have a fixed rate, because you're likely in the low 5s to, low, mid, high 5s, somewhere in the 5s, I guess anywhere in the 5s. Um, and rates are much lower now, especially even to restructure that. So there could be a good opportunity there where we can assess, like, what is the penalty? How much interest can you save? If you're only a year and a half in, and you have a 5-year term, I mean, there could be an opportunity there where you might save tens of thousands of dollars in interest and payments. Definitely reach out to us. We're happy to do those assessments for you. There's no cost to it. Like we just basically can assess it based on your specific financial picture. But it could be a really good opportunity just based on what I just went through with those clients. Like they couldn't believe it. They're like, well, we're going to get an even better rate. Like that doesn't even make sense. But that just shows you how much the market has changed, like you said, over the last 12 to 18 months, you know?
Yeah. Yeah. I mean, and it's going to continue evolving. There's so much going on, and things can also change very quickly as well. Maybe maybe out of nowhere, we're able to actually come to an agreement with our friends to the south on tariffs.
Or
But then there's also most economists that just predict and expect that we're going to always have tariffs on certain items, and that's
Mhm.
going to be the new norm going forward. So again, like whether it be that discussion, whether it be geopolitical influences, whatever it may be, time will kind of tell whether the market can pick back up. But right now, the way it's trending is certainly continuously going down, which is trending also towards we've had a contracted GDP. GDP like that continues, official recession that will plummet rates, things like that. So there are these other influences that could really expedite any sort of lowering of rates. Which, on the flip side, as opposed to um, a slow reduction in rate, which kind of keeps the market balanced in the sense of no real hysteria around, now people can afford, kind of like what we saw during COVID when rates were like mid ones, to mid twos, it stimulated the market because money was free. So if we have, the other side to it is if we have the, a significant drop in the economy, and we do have continuous quarters of negative GDP and hit that official recession, and that is all in the news, and we have the Bank of Canada having to pull that lever to plummet rates and the bond market drop, mortgage rates come down. Well, is that going to be finally the precipice that kind of that where people jump in the market and that, quick rush? I'm not saying it's going to happen, but is that what people are also waiting for? Who knows? But I would hate for that. I would hate to see that happen, of kind of going back to that hysteria of COVID days. But the way we're kind of trending right now with unemployment rates, with contracting GDP, businesses reducing their investments, defaults to businesses, individual bankruptcies and consumer proposals on the rise. Like, all of those are signaling like our economy going in the gutter. And so, number one, I hate to see that, period. But also the flip side is like, then yeah, it's great, drops mortgage rates, but it also can absolutely drive the market, where then it pushes pricing up again, which then becomes out of reach for a lot of those that have been waiting on the sidelines, or thinking about getting into the market, or that are just becoming of age, or just getting their first job to be able to buy, and are kind of, again, continue to be stuck behind the 8 ball.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
Yeah, and just kind of to touch on that, first-time buyer or, starter home type thing, there was an article that was in the Canadian Mortgage Trends just talking about housing starts or lack thereof. I just want to give you a quick summary. The title was Housing Starts Flat in First Half of 2025 Amid Declines in Condo Projects. This was from CMHC. So quick summary, CMHC, Canada Mortgage and Housing Corporation, reports that housing starts in the first half of 2025 remain flat compared to 2024. While cities like Calgary, Edmonton, Montreal, Ottawa, and Halifax are holding steady or booming, Toronto has hit its lowest annual pace in 3 decades, largely because of a 60% drop in condo projects. Vancouver also saw declines, making these two major markets outliers in an otherwise stable national picture. CMHC's deputy chief economist warns that the downturn could have longer-term effects on supply, especially as demand pressures remain strong in major urban centers. The sharp fall in condo starts may limit future availability, worsening affordability challenges down the road, even though smaller markets are showing resilience. So kind of exactly what you said. And let's not forget that a lot of these housing starts are also employers. Like, all of these construction sites, jobs that aren't happening are jobs that aren't created. Like, nobody's working these jobs if there's no homes being built. So it's kind of like a double-edged sword. There's unemployment, and then we also have a lack of these starts. So a lot of people that are working in the trades are just not having any work to do right now, which is a huge issue in these major cities.
Yeah, there's that notion that, well, we don't need more housing in these cities because there's so much supply. Obviously, they're not being absorbed. Those are people sitting on the sidelines, like renting instead, living with, family still, living with friends still, kind of that group home kind of style, multi-generational style living, as opposed to getting their own place. And so, yes, these housings, yes, there is supply on the market that needs to be still eaten up. However, these lack of housing starts, it's really felt like years down the line. It's not something that you feel right now. That's years down the line. That'll be a result of driving up housing costs. And, even though we have most of the builds right now are purpose-built rentals, we're
Mhm.
still going that's that lack of build, because even as on the rental side of things, those are slowing down, even though the predominant portion is rental starts. But that's going to influence rents as well down the line. Like you mentioned that in Toronto, that the housing starts, and by housing starts meaning like start of a project, and you said it was the lowest in 30 years. That's since 1996 that it's the
Mhm.
lowest since, which is like absolutely wild to think about. Um, and it's a 60% decline in condo starts in the first half of 2025. Um, and that's like it's really weak pre-construction sales, low investor demand. They're not going to they're really not going to start any of these anytime soon. And really, with any of these delays, with how much the holding costs are, development fees are, and how slow a process it is, it's any sort of delay is just going to be exacerbated down the line.
Yeah. What do you think, Dave? Do you think that policymakers need to intervene, or like as we've seen in the last couple of years, the market seems to always correct itself, whether it be job, housing starts, inflation? Like, obviously, at some point you have to intervene, but do you think it's best for policymakers to intervene at this point? We've talked about removing, different permit costs and kind of startup costs for these projects, or do you think it's best to just let the market kind of correct itself?
I think both sides of the coin. I think market let the market correct itself without putting unnecessary pressure on the market. Like at the same time, I think they should be letting like overall supply and demand kind of take care of itself. But then further to that, with the anticipation that these starts aren't happening right now and they're going to start in the future, and they're going to need to be sped up, and they're
Hmm.
needing to be cheaper, because people, when they do start, people are going to need lower cost housing, lower cost rents. So right now, take the time. Don't intervene of putting stimulus into that market. Focus on right now reducing the red tape and the cost of like permit costs, development fees, and speeding up and implementing some tech that's going to speed up those the permits and the issuance of permits for people to be able to build, so that it's not taking years from when they do want to start, because that's how long it takes to get through the city of Ottawa, the city of Toronto, Vancouver, et cetera, et cetera. So use the time now, not to intervene to influence the market in the sense of pumping it or anything like that, but just in more of like the planning for the future of like everything that every party has talked about in every level of government. None of it's being corrected, of like speeding up the timeline to build and reducing the cost to build. Focus on that. Let the market, regular supply and demand, take care of itself. And at the same time, like also be wary and make sure that we're not unnecessarily and unduly influencing the economy and the market by opening up the floodgates of immigration, of things like that, or foreign investment. We've had that ban for a little bit now, which I think actually stymied quite a bit of that, which I
Yeah.
think is a good thing, because it has been driving down the prices in places like Toronto, et cetera. So don't open up the floodgates. Like I think that ban is up in 2026. It might be worthwhile to extend that. And maybe leaving it open, not necessarily an exact date. Who knows of when that's going to end, but maybe just renew that. But let the market take care of itself. Focus on that cost of development, the speed of development.
Yeah, I just searched this here. So the foreign buyer ban is in force until January 1st, 2027. So we got about, you know,
Another
16 months, 15 months, something like that.
Yeah, yeah. Just so like leave that you know intervene by this in the sense of like, don't put undue pressure on the system. We already have pressure on in multiple areas, not just in housing, but by opening up the floodgates of the borders, let the market take care of itself domestically, and then also and then like just like I said, reduce that red tape, reduce that cost to build, and so when builders do want to start building, they can at an expedited fashion and not at the cost that they're used to like they are right now.
Mm-hmm. Couldn't agree more, David. Couldn't agree more.
Well, sir, should we slide in some mood boosts?
Yes.
I think people are probably tired of hearing me talk.
Hey, you really held it down today. I feel like I just kind of like, I was just throwing like lobs at you. Just, hey, home run. Okay, so I got 3 today. I think they're all pretty good, but you be the judge, Dave. Your expressions will tell us the tale. Number 1, if you have 13 oranges in one hand and 10 oranges in the other, what do you have? Big hands.
Wow. Mm-hmm.
Big hands.
Yeah.
Number 2, what do you call someone who has immigrated to Sweden? Artificial sweetener.
Wow. That's so bad it's good.
And number 3, what do you call an apology written in dots and dashes? A remorse code. A remorse code. Ding,
See,
ding, 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 ding.
The first one wasn't, there was no pun involved, and so
Yeah.
the other 2 are pretty good.
The other 2 are punny. Well, thank you everyone for tuning in. We're here every Wednesday, 10 a.m. And be sure to follow us on our socials. Okay. And we just want to give a quick shout out to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, and Centum. Thank you so much for your support. And thank you everyone for listening. We'll see you soon. Have a great week.
Deuces.